So Oliver, EJ, I see you're already in the speaker zone. Are you able to speak? Can you say hey if you hear me?
Hello, hello.
Oh,
Good
hello,
morning.
hello. Morning. Okay, perfect. EJ is there. Oliver?
Yeah, I'm here as well. Hey, AJ.
Okay, great. And I see Stefan just joined. So today we will start as usual with Oliver presenting our data and predictions for the BLS just before the release. And then we'll have a discussion once the data is released between our speakers and guests. And we have today Bianco Research, so Jim Bianco from Bianco Research coming. He's not yet here, but I hope he comes during our presentation. And I think we can start with Oliver and then discuss a little bit of his insights and see how what data is released. So Oliver, please start.
Hey, thanks a lot, Nat, and thanks a lot to the host and also to our guests, BJ Antoni. And as soon as Bianca gets online, welcome to him as well. But it's good to be here, and it's good to be sharing our forecast for the December BLS CPI release, which is due in about half an hour. I think before sharing the release and our forecast, there's a couple of things I wanted to share with everybody. The first one off the bat is I think we're still not out of the woods yet in terms of the BLS data accuracy. There are a number of issues with some heavy imputation for last month's numbers, the truncated holiday sampling collection. But most importantly, I think the month-on-month comparison, which resumes this month, but it'll be based on a questionable number in November. So please, whatever your interpretation, please treat the month-to-month comparisons with caution. And so the way we have progressed about it is looking, or what some individuals are looking at this, is trying to compare the December number all the way back to the September number. So it's December versus September. But we'll see where that goes depending on what the results come out with. Having said that, where does Truflation see inflation coming in at, as reported by the BLS CPI? Market consensus is around 2.7%, but there's a huge range. At the lower end of the range, we're seeing a number of forecasts, and it's not just one or two as outliers. It's quite a large group of individuals. I'm comparing around 49 different economists. And at the lower end of the range, you've got about 2.5. And at the higher end of the range, with FactSet, you've got about 3.1. So there's quite a big variation in the forecast this month. But Truflation is predicting the BLS to come in at 2.6%, so just beneath the market consensus of 2.7. And the main drivers of the annualized forecast, year-on-year forecast of 2.6, which is a marginal reduction from the forecast in November, which came in at 2.7. And the main driver of that marginal reduction is the goods inflation, which is cooling, which I know goes against a lot of people's expectations because of tariffs. But if you look at it, we've seen some improved supply chain dynamics. We've seen some rollback of tariffs and reduction of tariffs, the rollback, of course, being agricultural tariffs. And second of all, you're seeing the rollback of the reduction in the tariffs applied into China, which is about a 15% reduction in tariffs from China. I think then the other factor to look at is services, and the cost of services have held relatively stable, and that's because of the higher wages, which is making services more sticky, and there's also elevated input costs that are maintaining that. And so we're seeing, certainly as the Christmas season comes in, we're certainly seeing a greater expenditure on dining and out-of-home entertainment. We're seeing strong impacts of AI in the servicing sector. And of course, there is increased demand for business travel at the back end, less so on the leisure travel. which has seen a significant drop off. And we've done some modeling out on how exactly is the impact of wages on um, on services, in particular non-housing services. And we see about for every 1 percentage point increase in labor costs, you're seeing about a 0.15% in non-housing services. Now, obviously, that varies by category, but certainly gives you a bit of an indication of where things are progressing. I think on the flip side, we've also seen some increased holiday spending in terms of household goods or gifts, decorations for the households, and so forth. That has certainly driven up prices. And then the other major decline or driver of the decline downwards, of course, is oil prices. And that has not only a result of increased output in the US because of increased refinery efficiencies, but I think also because of general, not even non-OPEC countries have increased output that is keeping prices relatively low for traditional historical averages. So we certainly see there's going to be a bumpy ride ahead. If services accounts for 2/3 of economic activity, we certainly expect some bumps ahead because of that, of the goods scenario, but a lot more stickier with results of the services aspect. The only other thing I wanted to mention, and then we can open it up and see if there's any discussion points. I think the 14th of July, i.e. tomorrow, will be an important day to decide what happens with the Supreme Court decision on the validity of the reciprocal and fentanyl tariffs, which is expected tomorrow, and that could have wide-ranging consequences, either positively or negatively. So we'll see where that progresses. But in essence, we are certainly seeing a more consistent outlook and a bumpy ride of an outlook. And then eventually, after the bumpy ride, we certainly expect then inflation to moderate a bit in the second and third half of the year.
Thank you so much, Oliver. And I think we saw like a massive cooling recently as well. So maybe we can discuss this a little bit. And just to repeat for everyone, our prediction is 2.6. So at the lower level of the consensus and all the banks today. So we're very very curious what the actual number will be in 20 minutes. And maybe we can start with EJ. He's from Heritage Foundation and he is also Truflation's advisor. What do you think about our numbers for today? And what do you think about our numbers dropping significantly in January? EJ.
Well, thank you very much. And first off, I have very little to say because Oliver made so many great points. He ended up taking a lot of what I wanted to say. He was right on so many counts. So let me just add a couple of things. Number one, I think the 2.6 number makes a lot of sense for a couple of different reasons, and not just me here. The economists at the Federal Reserve Bank of Cleveland actually came up with the exact same estimate. For them, it's 2.57. Obviously, that rounds to 2.6. And again, I think this number makes a lot of sense. Oliver outlined many of the reasons why. If we look at not the year-over-year number, but the month-over-month number, Oliver already outlined why we have a lot of problems with that in terms of interpreting it. You know, for the November number, obviously there's holes in the data going from October to November, so forget about that. But just the November number itself had a lot of holes in it. Some of that is structural. In other words, not all of the data is collected by BLS every month anyway. There are some cities, for example, some major metro areas where they just don't collect certain price data in certain months. It is done bi-monthly. As a result, you have, in some cases, the data was not collected in September and November for methodological reasons, and then not collected in October because of the shutdown. So now you have this huge gap. This is making it not only difficult to interpret month-over-month data, but it's also going to mess with some other parts of their algorithm, if you want to call it that, seasonal adjustments are particularly problematic now. And unfortunately, BLS already had problems with their seasonal adjustments. One of the things that they do is they actually adjust seasonality too frequently. And the result of that is when you have structural changes in trends, in other words, when inflation is trending up and it starts trending up faster, or it starts trending up slower, or maybe you switch from inflation to deflation, even if it's just for a month or two. Whatever the case may be, the way the math works, the linear algebra ends up chalking that up. It ends up allocating that change to seasonality instead of actual change. And so the seasonal adjustments end up hiding that, and then the revisions to the seasonal adjustments down the road will expose the change for what it really was. So for all these different reasons, this is all really, again, on top of what Oliver already outlined. The month over month number is not something I'm paying particularly close attention to this go around, because there's just too many issues with it. Some of those issues, not all, but some of those issues are just completely taken care of when we look at the year over year number. And again, that's because you're not only are you not dealing with the seasonality, but you're actually incorporating some data from November and December. Going back to this idea that not all the data is collected every single month, the way, again, the way the math works here is data from November ends up getting carried over to December to fill the holes that are in December because of data that just isn't collected, part of the normal process. So to sum all that up, sorry, this is a bit long-winded, but to sum all that up, I think 2.6 on the headline for the year over year makes perfect sense, and I'm pretty confident that we're going to get a number relatively close to that. Again, the range is wide this go around. We have a fairly wide confidence interval because of all these data collection problems, but I'm certainly not looking at any of the estimates on the very high end as being reliable here on that year over year number.
Wow, thank you so much. It's always lovely to hear, especially when you talk about BLS numbers, because you're an avid proponent of innovation in that data in Bureau of Labor Statistics. And just a reminder that they are collecting just household surveys, around 60 to 80,000 data points collected by hand, analyzed by hand. So during the shutdown, when there was no employees in the government, they couldn't collect it. So October data is completely missing. November data has been collected starting, I think, 12th of November and expanded to the later month. Weights have been shifted a month. Whilst we are analyzing real price data at the stock keeping unit and at the sales point, we have 35 million data points for multiple indexes from 70 sources. So I think we are a little bit more reliable in terms of actual pricing and more accurate in terms of current data. So we have data daily that comes in a bit earlier. And we even have a report where our data is 45 days ahead of the BLS data in actually predicting trends. The data is never the same in raw numbers, but we are a leading indicator for the BLS changes. Maybe Oliver knows better. If you want to add something, Oliver, to my summary, let me know.
No. I mean, I think like their more traditional collection methodologies versus the approach that Truflation is taking, which is taking census level data. We're tracking over 18 million items in the US of prices of goods and services across all the 12 categories that we track. And I think it gives us a pretty nice viewpoint of the market from a consumer standpoint and the impact they're facing from an inflationary position.
And just a question from the audience. Can you predict maybe core CPI, and what would be your prediction if you were to predict it, just roughly, if possible at all?
So we don't have an accurate prediction of core at the moment. We don't predict core. We do give it to our main clients. And the part reason is the definition of core is significantly different. So we've had to align our data sets to the to the BLS category definitions, and then predict out a core from there. But we're certainly expecting the core to be roughly in that same range as well, is holding steady from last month, rather than any significant movements, with some down and some up, and they're balancing each other off, with the volatile categories of energy and food, in particular energy, seeing a significant drop off. So we're certainly expecting the non-core to see a drop, and the core to hold relatively steady.
Wonderful. And I see that our guest, Jim Bianco, just joined in as well. Jim, just to recap we were just sharing our data trends for the upcoming release, which our head of data estimated at 2.6, so at the lower end. And you know that our inflation is cooling. Jim Bianco is part of the Bianco Research, which is like investment analysis for institutional investors more. And they are doing a lot of unbiased analysis for Wall Street, and also using our data. So, Jim, what do you think about this data that you see recently cooling a lot, and our prediction of 2.6 for the upcoming CPI, if you can share?
Natalia, you might need to make him a speaker.
He is.
No, yeah, I'm sorry, I was muted. That sounds about right. Wall Street is looking for 0.3 on both headline and core, and 2.7 on the year over year for headline and core. All right, 2.6, 2.7. I mean, there's surrounding error in there between the differences between the two. So I suspect that those will be, somewhere around the right number.
Fantastic. And thank you so much for coming. And also let us know what you think about the Truflation data in general recently.
I like the Truflation data. I've been a big fan of it. I know it has been trending lower in the last month or 6 weeks or so, but it tends to be a little bit more volatile than the CPI numbers. And I know it goes up and it goes down quite a bit. It was pushing 2.7, 2.8%, back in November and December, and now it's back under 2%.
Yes, for sure. And we had a spur below 2% as well from, I think, March to May. That wasn't really registering that well in the BLS data. Our data goes much way higher and lower. And it is kind of also in line with Pennsylvania State research on the rent index that also shows that BLS is maybe smoothing their data a little bit. So they always... they never register big heights or big lows, which is probably part of their methodology as well, on purpose. Plus, our data is year on year, so every day compares to a day year ago, so that makes it also a little bit volatile. Okay, we still have 9 minutes till the release, so maybe we should discuss what we think about the recent Kevin Hassett and the federal chair situation. Who's going to be chosen, and what do we think about the Powell investigation? Anyone?
I'll go first. Starting with the Powell investigation, it's unnecessary for to turn Jay Powell into a martyr. I don't understand, especially in what they're investigating him for. Now, if you want to investigate the Fed because they're blowing $3 billion on a couple of building remodels, I'm all for that. I don't know how they could wind up spending that much money to build these temples to economics. But that's not what they're investigating him on. They're investigating him on supposedly lying to Congress about what they're planning on building that hasn't been built yet. Anybody who's been through a construction project knows, hey, you're given rules and you say, hey, we're going to do this. Okay, fine, we're doing this. And then next week, okay, scrap that, we're doing that. And, if you're going to go back and say, you lied to me a week ago about what you were going to do, that's not how construction projects work. So the question then becomes, why is Trump doing this? And I'll tie this in with Hassett. If you look at the poly market betting right now, neither Hassett or Kevin Hassett are trading above 40%. Hassett at one point last November was trading at 85. There is no clear favorite to be the Fed chairman. My interpretation of this is Trump doesn't like any of these candidates. And Trump is searching for, let's call it, to use the old, let's make a deal, door number 4. Or maybe he winds up picking one of these candidates, but he's not sold on. Trump told us in November he had made up his mind. And here we are now in the middle of January, and I think he still has to interview Rick Reeder. He's not even done interviewing in the process, or maybe he interviewed Rick Reeder last week. But he still hasn't made up his mind. He doesn't trust these guys. Trump is a true believer that the funds rate should go to 1%, full stop. And he wants a Fed chairman who is going to go in there, not pay attention to the data, cut the funds rate to 1%. And he needs a club to make sure that this Fed chairman does what he wants in the future. And that's what this is about, the ability to fire the Fed chairman. So that the next guy in, he's getting a club over his head. That is the only logical thing I could think of why he would be doing this. Otherwise, there is zero chance that he's going to get him out before May. Even if they indicted him later today, the courts will prevent them from removing him. They'll litigate it, and it'll go well past May when Powell's term is over. So it makes zero sense why they're doing this, other than it's for the future, that he wants the ability to fire Fed officials that don't agree with his policy.
And just a reminder that Chair Powell is there till end of May, indeed, and he can still do quite a lot of damage. I think that's the assumption. EJ, you wanted to say something?
Yeah, thank you. There's a couple of things at play here, one of which is the fact that the referral here didn't even come from the White House. It came from Congress. In other words, it's not even clear how involved the president was on this move. The other thing is that I'm not sure it's a question of the president doesn't have a clear favorite. I think that's probably Hassett. I mean, Hassett already works for the guy, and Trump does not hesitate to fire you if he doesn't like you. But as Hassett pulled ahead in the betting markets, the bond markets didn't seem to really like it that much. And so I would not be surprised if our Treasury Secretary, Scott Bessent, who very much has the president's ear and very much has his finger on the pulse of the bond markets, has been monitoring the situation and is perhaps suggesting that Kevin Warsh go in there instead. Now, that is an unknown for Trump because obviously Warsh does not work for him currently. Hassett does, and I think the president has been happy with the job that Hassett has done in the White House right now. So I'm not sure it's so much that the president is waffling because he has trust issues with these folks. I think it's much more likely that what's at play here is a question of how far can Trump go in terms of getting the candidate that he wants without the bond markets, without the bond vigilantes really trying to have their way? Because at the end of the day, that's what Trump and Bessent really have to keep an eye on. They have to get Treasury yields down in order to get the interest on the debt down, because that continues picking up as the debt itself is growing and as more and more of these notes and bonds that were previously at lower rates are rolling over at higher rates. So there's a lot at play here. And then lastly, one thing I'll say is that Powell is clearly making this more political than it has to be, actually. I know a lot of people are saying Trump is making it too political. This is a two-way street here. Powell is a lawyer, and he knows better. He knows that an indictment is only going to come if two things happen. Number one, if he refuses to provide the DOJ the same evidence that he already refused to provide Congress after Congress asked him for the data. That's the only reason this was referred to the DOJ, because Powell refused to provide them evidence. So if he continues down this path, then yes, that's when an indictment comes into play. Or what's behind door number two is if the evidence he provides proves that he did in fact lie to Congress in that testimony in the first place. So the fact that he even mentioned an indictment was him politicizing this, in my opinion. This did not have to go this way. He could have simply complied with the request from Congress, given them the evidence that they requested, and this never even would have gone to the DOJ. It never would have been referred to them in the first place. What was referred to the DOJ, as far as we know, was not a claim of wrongdoing in terms of Powell misappropriating funds, but a claim of wrongdoing in terms of him stonewalling Congress and refusing to give them the evidence that they requested.
Wow, thanks so much for this this view from a more legal perspective. We do also get the feeling that they are, of course, trying to oust Powell because of the interest rates, but also they find it difficult to find a good legal ground for it. And it's surprising that this 2.5 to 3 billion spending on the renovation is not grounds enough for investigation, just from our perspective. But yeah, I think they're doing what they can, and maybe the data is coming, but maybe we can also talk about the bonds market and how dangerous situation might be for the debt, but also seeing the cooling inflation and how that is dropping dramatically recently in our data. And while you talk, we will jump also into data with Oliver that is coming out in 1 minute. Jim, did you want to take it up?
Yeah. You know, as far as the data that's going to come out in a minute, I'll bear in mind too that the data is going to be, it's been skewed because we're missing the October data from the government shutdown, and that has really impacted rents. Rents are done on a survey of every 6 months. We've missed the October survey, so for the next 5 more months until we get past that October survey, we're going to wind up seeing a problem with the rents. By the way, the numbers are out. They are right in line with Wall Street's estimates, 0.3 on both headline and core monthly number, and 2.7 on both headline and core the year over year. So they are, at least the headline numbers are right in line with what Wall Street expected. I haven't gotten a chance to look at underneath those numbers.
Oh, fantastic! So we are even lower than them. So they haven't caught on yet, and I think they are still, as you said, using a little bit of estimates for October, November. So they might be even more delayed. Than
usual.
You
know what? Let me refrain that. I misread my screen. Core came in at 0.2, not 0.3. I misread my screen. And the headline is 2.6 on core. Headline inflation came in at 0.3, and the headline is 2.7. So core came in slightly below the estimate at 0.2. I haven't seen the 3-digit number yet. And so that one kind of was a little bit better than expected.
And if I can real quick, looking at just the shelter component, that was up 0.4% in December, seasonally adjusted, which is, I think, way too high, and then 3.2% year over year. So clearly, BLS is still missing the deflation in rents in a lot of markets, which should be factoring into not only the rent data, but also the owner's equivalent rent. They look at just pure rent prices when doing both of those imputations. So clearly they're missing out on the current mood, if you will, of the market. And what we're seeing right now is the lag that is built in to those estimates. So BLS will collect rent information in a certain month, but it is not all added to the index at once. In other words, only a portion of it is, and then it is averaged into the index in coming months. And this is the lag that they often talk about in that shelter component. It was part of the reason why the CPI was slow to rise in 2022 and why it took so long to peak. And now we're seeing it the opposite effect, why the CPI is slow to come down. It's not capturing the deflation in shelter in certain markets, at least not all at once. It's going to take more months for it to filter through, so to speak.
How much deflation do you think there is in shelter right now?
It varies a lot by market. So if you're in a place, if you're in a major metro like Austin, let's say, or Tampa, it is significant to the point where in Austin, relative to income, rents are approaching a record low. And that's just all a result of how much building has gone on in Austin and in Tampa. Now, in Austin, you've also seen a bit of a decrease in demand, but in markets like that, it's really, really significant, and that should be showing up again in the macro level data. In this case, in the nationwide data. But unfortunately, we're just not seeing that come through in the top line number here. And again, it has to do with how the math works at BLS, where they don't include all that data at once. And to a certain extent, there's a good reason for that. You know, rents are not, your rent is not redone
Yep.
every single month, right? Most people are not on a month-to-month rent. The most common one is a 12-month. It's a year-long contract. That's what you get with your landlord. And so even if rents do dramatically change in 1 month, they've only changed for those Americans who are renewing their rents that particular month. And that's the logic behind why CPI, or I should say why BLS builds this into the CPI, this lag. Unfortunately, though, it doesn't necessarily give you a good sense of what's going on in the economy this moment, the way Truflation does with capturing prices literally every single day.
Yeah, I would
Just
emphasize that you're right, that rents don't change that much. So they have EJ, you could probably explain this better than me, but they have a pool of rental units that they measure, but they only call them twice a year, every 6 months, because you don't need to call them every single month, because most of the time the rents you're charging this month are the same that you charged last month. So they only bug them twice a year. And that's where the numbers come in with that 6-month lag with October. Hopefully I said that correctly.
Oliver, go ahead.
Yeah, I was just going to say, look, I mean, I think the housing market, I mean, there is that element. I think Bianco, you're certainly right on that calculation and that assumptions. That's certainly what we're expecting as well. But I think also as a result of that, and then using that as an imputation on the owned, which I really struggle with. And if you look at the data they're releasing and you look at the granular reporting, the owned category is still also seeing an increase. And there's no way the owned category, if you look at any third-party alternative data sets, the owned market, whether you're looking at from a whole bunch of different providers, but even if you look at like the NAR, for example, or CoreLogic, or all on the owned guys, they're all seeing reduced prices and coming down, if not holding steady at a max, certainly not increasing. And I think some of that's also where a bit the struggle is of trying to use the imputation of the owned market, the rented market, onto the owned market and creating their owner equivalent rent. I think that's certainly one element. I think the other element here is in the rented housing space, and it's no surprise to see rented going up. People have not been moving out of their rented to buy properties with mortgage rates not coming down strong enough. The housing supply hasn't come out that much either. So you couple all that together, it's not surprising to see rental markets and landlords trying to recoup all their incremental costs that they're incurring back on whenever those rental agreements renew. And certainly in line also with the Penn State's numbers and the Penn State analysis, which is where we are closely tied to as well. We work with them quite extensively, and we've done a whole bunch of analysis on new rental agreements versus old rental agreements or existing rental agreements. And both of those are holding relatively stable, if not marginally increasing, which is totally understandable. But it's the owner equivalent rent that's the issue. I think the other, looking at the data sets in here, I think the other one that's a bit of a surprising is the overall energy market that has seen an increase. Yes, you're certainly seeing an increase in fuel and gasoline costs and stuff like that. But I think even on the energy services like electricity and piped gas, natural gas commodities have dropped massively in the last three months. So I'm a bit surprised to see that come up so significantly. So I think the rest of it looks roughly what we were expecting and in line. The one outlier for us beyond that is in the apparel industry. We were certainly expecting apparels to drop given the huge amounts of inventory clearing that the retailers were doing for winter apparels. And they're seeing a significant increase where we have seen a bit of a drop in apparel. And when we look at our data coming from retailers directly, it's certainly a bit surprising to see their growth rate on apparel as well. So I think, I think there are some ups and downs in the numbers, whether that's a result of some of the sampling issues they're facing on housing, definitely, but also on the lag. I mean, I think if we look at the lag on housing to Truflation, we're seeing about a 7-month lag of where the BLS is versus when we're reporting. And it does catch up over time, and we can look at the trends for forward trajectory. So, bit surprised, not too surprised on the differences of the numbers there. But on energy and apparel, I'm somewhat a bit surprised on the numbers.
That the apparel issue strikes me in particular as something that I know you mentioned sampling that is likely coming from the missed cities, the missed metro areas, and the imputation that they're having to do because of that. So I mean, all in all, I think once you account for the different the different methodological differences. We really didn't see any big surprises here, right? I think Truflation pretty much hit this one right on the head as much as they could, given how wide of a confidence interval you had to have because of all the missing numbers at BLS and because of all the I'll just say the errors that they have in the way that they produce these numbers. And I don't say that lightly, errors. But the fact of the matter is, they need to improve their methodologies. They need to do better than just surveys. They need to get into the data scraping world, and they need to stop relying on basically these different correlation matrices that clearly don't work anymore, that clearly don't represent reality.
That's music to my ears, EJ, because I've been kind of arguing the same thing, that the biggest failing in the government data, and you'd even put this in BLS with payroll data and the like, is that they do surveys, and the response rates are down. There is plenty of what they call administrative data that they can look at. Look, Truflation would be an example of administrative data, where you're actually looking at actual data. You're not just surveying some and then applying it to the larger whole. And I've been hoping that there would be a move at the BLS towards doing something along the lines of more administrative data and less sampling and surveying.
Yeah, that's certainly what we were hoping for as well, and I think we've managed to engage with other and other countries and doing equivalent of what we're doing in the US, the CPI metric, especially like in Argentina. We're working with the government there, and certainly our intention is to see, and not I'm not boasting and saying they should replace the data, but at least look to amalgamate the data and use it as another data source. And modernize the methodology and the collection. And I certainly think they have to look at this owner's equivalent rent, because it doesn't represent reality in the marketplace. Because I mean, how many? I think is the number. I don't have the exact number off the top of my head, but it's quite a significant number of the U.S. population that has still got their fixed mortgage, their 30-year fixed mortgage rates at pre-2020 levels, which means they're extremely low where they are today. And in terms of their impact on pricing, it doesn't adjust accordingly. And so then translating that then into purchasing power and what's driving the U.S. economy, which is the consumer spending and continues to drive it, is quite worrying. And certainly there is a need to modernize the methodology of what the BLS is doing. And adapt to the changing environments that we're living in.
And if I could jump in on that, when we talk about owner's equivalent rent, to give folks an idea, many people don't understand how bad of a metric this can be. It does not look at home prices. It does not look at interest rates. These are the two primary drivers of your monthly mortgage payment. Yes, I understand a lot of people do escrow, and you'll have other things in there, like your if you have PMI, for example, that'll be in there. If you have homeowners insurance, property taxes, et cetera, and obviously all of those things have increased over the last 5 or 6 years. But the primary driver of your monthly mortgage payment, again, it's the price of your home, how much you're going to have to borrow because of that price, and the interest rate. And those things aren't even included in the things that BLS looks at. What do they look at? They just look at rents. And from the increase in rents, they not only create the rent price index, but they also impute from that the change in owner's equivalent rent. So it's not as if they go from house to house every month and ask people, what do you think you can rent your home for? They do that initially, but it's just to create the weights of the two categories in terms of the change, the month to month change in owner's equivalent rent. That is derived from the change in rent prices. So when you have these markets where the cost of home ownership increases much faster than the cost of renting, which is exactly what happened after 2020. This is right now we have the largest gap ever. The premium on home ownership is the largest it has ever been relative to renting. Okay. This unprecedented gap is completely uncaptured by the index that BLS produces. And that's something a lot of people need to realize. Now, likewise, as the cost of home ownership has started to decline, and it is by my estimates off about 5.2% since this time a year ago, since January 2025. That is likewise not being captured by owner's equivalent rent. While the actual cost of home ownership has fallen again, roughly 5.2%. Instead, owner's equivalent rent has gone up during that time.
EJ, if I could ask you a question about owner's equivalent rent. Back in the 80s and earlier, they used to look at house prices, but then it was argued that a house could go up and down in price, not just because of inflation, but for a real basis. In other words, it becomes more valuable, the neighborhood becomes more desirable, and we don't want that to be confused with inflation. So, aren't they what they're trying to do is separate out your home price might go up because your neighborhood might become more desirable, or go down because your neighborhood becomes less desirable. But let's not confuse that with the inflation of homes, and that they're trying to separate out the two of them. Do you agree with that? And how would you fix that?
Well, that was certainly the excuse one of the excuses that was given for the change. But BLS doesn't use that excuse for literally anything else in the index. Instead, what they use it's something called a hedonic adjustment, and it essentially
Right.
tries to account for the change in quality. This is why over the course of something like 10 or 15 years, according to BLS, the price of a new vehicle in this country didn't budge. It was basically just flat because they assumed that all of the increases in price corresponded one-to-one with increases in quality, whether consumers wanted that stuff or not. And this is one of the problems with federal regulations. Is that if the federal government mandates something like they've done now with backup cameras in vehicles, and all other kinds of safety features, which, don't get me wrong, those things are nice, but they do significantly increase the price of an automobile in this country. Well, BLS assumes that if consumers are all buying the upgraded option or the upgraded version of a product, then BLS assumes that consumers must think that this is worth the increase in price, and therefore the hedonic adjustment simply cancels out the increase in price because BLS assumes if consumers do prefer this option, then they must think that the increase in quality is equal to the increase in price. The result is that it takes out the increase in price from the index. Well, if it's mandated by the government, you don't have an option, right? You have to swallow that increase in price, whether you think the quality has gone up or not. In some cases with regulation, the quality actually makes products worse. Look at in the United States, because of energy and water requirements on home appliances like dishwashers or clothes washers, that has those regulations have dramatically increased the cost of those appliances and made them worse. A lot of Americans know you have to wash your dishes or wash your clothes multiple times in order to get them clean, versus with the older appliances, you could just put it in once and voila, the appliance would take care of it for you because it used more water, it used more energy. And so now, even though again, the quality of the appliance has gone down, people are actually paying more, and the CPI is not capturing that increase because it assumes the quality has gone up. So this is a bit of a tangent, but just so we understand the why behind the hedonic adjustment and that excuse that the BLS is using there. The biggest reason, however, that they give today for why housing is not included is because they currently treat housing not as a consumable, which they say that's what CPI is designed to capture, the basket of consumables. Instead, they treat housing as an investment, which again, I think you can make a case for that, but not a very good one, because yes, housing does go up in price over time, but it also is very much a consumable. It's a necessity. I don't think anybody could say that, well, food is just an investment, right? Because you're buying the food today so you can have a better future tomorrow. Yeah, so you're not dead. Obviously, being alive is preferential since death is suboptimal. But it doesn't. Again, in my opinion, the argument doesn't really work. That housing is somehow only an investment and not a consumable, and so therefore we're not going to include the cost of home ownership. However, they say renting, the landlord is just providing you a service. And so that service should be captured because that service is a consumable. It's again, I'm not saying I agree with it, but that's just the rationale that the BLS has laid out for why they do what they do.
So real
Just yeah.
quick, I was just going to say, for those that are interested, the bond market and the stock market are doing absolutely nothing right now. The bond market is, the 10-year yield is unchanged on the day, 417. S&P futures are up 6 points or 9 basis points. So there's a very muted reaction to this.
So
I was
maybe
just going to say to your comment, Bianca, in the question, and also to EJ's, if I look around the world and how housing prices are calculated, you can take Europe as an example. I'm not saying they're the best either, but I think certainly how we look at it is very much more in line of how Europe looks at it, which is basically by taking land registry data and looking at the completed sales, at what price that was paid for, how much down payment was made using mortgage approval data, and then assuming the down payment and then assuming the mortgage rate. Now, obviously, the mortgage rates in Europe are very different to that of the US, but then taking in the mortgage rate, and then you calculate the impact it has on consumers. Now, I certainly think that's much more of a consistent approach, and gives you probably much more of a comprehensive read of how inflation is affecting individuals, and in turn, what the purchasing power of the consumers are that would drive the economy forward in terms of the consumer spending. And that's certainly how Truflation looks at it. And it gives us a much more realistic viewpoint of the market. But it does have, I think either way, if you base it just on the sales data or just on a survey data that is done every 6 months, and then compute that, to use that data and compute the owner's equivalent rent, it's almost like you are having a data set that has got errors in it and duplicating those and multiplying the impact of those errors on owner equivalent rents. Because the owner equivalent rent is then adjusted by region, by location, by size of household, and so forth. And I think it's your base data levels that you're using are just off, and I think that just causes the overall concern. And elsewhere around the world, if you look at the historical trends of the BLS, and you look at the trends of rent, and you look at the price differences and changes month on month, or on a year-on-year basis, but look at it every month, and you compare the rent versus the OER, they're pretty much a mirroring effect. right? Marginal differences over time, and that's certainly not how the housing markets are physically operating elsewhere around the world, and certainly not what we're seeing in Truflation. So I just wanted to add that context to give you also some perspective of what other markets around the world do to calculate the impact of housing prices.
The other thing I'll add here, where is it on my screen? On my screen here, is that we're still at a 5% chance the Fed's going to cut rates in the January meeting, and at the March meeting, this is the futures market is putting a 24% chance that they're going to cut at that meeting. If you combine it, there's a 30% chance that the Fed will cut rates either at the January or March meeting. The next meeting after March is the May meeting, and that's Jay Powell's last meeting. So looks like the market is still pricing in that Jay will finish off without any more rate cuts.
Amazing. We have a question from the audience. Diego, maybe? Sorry, Steph.
No, I mean, the market, I think, is totally expecting Jay Powell not to drop any interest rates. And I think, yeah, I mean, it's pretty much the consensus, which seems to be proving out.
Diego, can you hear us? Ask your question if you can. Oh, no, I guess he dropped off. All right, and can we circle back maybe to this 10-year bonds? Like, if they don't cut enough, and if inflation is cooling so hard, like, what are the risks to the economy? Because it feels like Trump is just, his administration is really worried that it's gonna topple the economy with the debt and everything. Jim, what do you think?
Well, this is a complicated issue. Let's go back to September of 2024. That was when the funds rate was at 5.5%, and the Fed first started to cut rates. They've cut a total now of 175 basis points, 1.75%. In September of 24, the 10-year yield was at 3.6%. Right now, as I look at my screen, it's at 4.18%. It's 58 basis points higher than it was when they started cutting rates. Mortgage rates are 20 basis points higher than when they started cutting rates in September of 24. So we're talking about 16 months ago. You have to go back to the 1970s to find the last time that the Federal Reserve has cut interest rates this much and long-term yields went up while they were doing it. So there is a latent concern, is the way I've been putting it in the bond market, about this policy, because it's not responding. And if you want to go back to when the Fed started these 3 rate cuts in September of this year, the 10-year yield was at 4%. It's at 4.18. So they can put out press releases that we're cutting rates and that will lower mortgage rates. It hasn't. It has not. Rates have been trending sideways to higher. And the last thing I'll mention about this, if you expand this out, we did this in a study last week, the 15 largest bond markets around the world, the 10-year yield, all of them are unchanged or higher since the beginning of last year, with one exception, the 10-year US. That is the only one that is down. If you look at 30-year yields around the world, not everybody trades a 30-year yield. I think of those 15 markets, 7 of them trade a 30-year yield, including, or issue a 30-year yield, including the US. All of them, including the US, are higher than they were in January of 2025. So the bond market is not responding to these rate cuts. Now, I've argued that the bond market is still got a latent fear about inflation. Maybe that's not it, but something is holding it back. And the old definition of insanity, which was, inappropriately applied to Einstein, doing the same thing over and over again, expecting a different result. We have cut interest rates 7 times, and we have not seen any movement in long-term yields. And I think that needs to be understood better, why the long-term bond market is not responding to all these Fed rate cuts.
I think it's because they're watching the Fed take with one hand, or give with one hand and take with the other. In other words, the Fed has talked a good game on fighting inflation, and yes, they've sold off a significant portion of the balance sheet, but now they're adding back to it. And so when they talk about, well, inflation has come down, so now we can cut rates. Yes, but you're also now back to buying bonds. In other words, the rate cuts are not seen by many as a sign that inflation is coming down and now we can price in less inflation into yields. But the buying of securities is seen as this is going to restart inflation. And so instead of allowing yields to come down as the Fed funds rate comes down, market participants are responding to this saying, we think we're going to have more inflation in the future, not less. And therefore, we want to be compensated for that risk with higher yields. I think that was particularly true. We first saw this over a year ago in November of 2024, right before the election. A lot of market participants interpreted the Fed's move then in terms of cutting interest rates as purely political. In other words, they thought the Fed was trying to get their preferred candidate, Kamala Harris, across the finish line by giving markets a little bit of a boost right before the election. And as a result, even though the Fed cut 100 basis points on its benchmark rate, again, the Fed funds rate, the result was that real world interest rates went up 100 basis points. The 10-year Treasury note, the 30-year fixed mortgage rate, those things rose instead of falling. So some of it, I think, just has to do with the fact that people don't believe the Fed anymore when Powell gets up to a microphone and says we see inflation pressures as cooling or accelerating, right? Whatever the case may be. I think this is again an instance of the bond market having the final say here and not having to swallow whatever political speak is coming out of Washington.
I would agree with that. And I think, just to emphasize that, in what the Fed did in September of 24 by cutting interest rates 50 basis points after Labor Day in an election year. Have they cut interest rates after Labor Day in an election year? Yes. But they changed policy after Labor Day. They were unchanged, and then they started to cut. They've never changed policy after Labor Day in an election year. If they were hiking, they continued to hike. If they were holding, they continued to hold. If they were cutting, they continued to cut. Here they were holding, and then they changed the policy to cut right before an election. And that's what smacked of it being political. Not that they were cutting, it's that they changed to cut that close to ahead. And they went 50 basis points as well. They didn't just do a standard 25 basis point move. So the criticism that the Fed has faced that was a political move, even though maybe the members of the Fed did not think of it that way. Like I've often argued about that move. If you told me that they were being political, that's exactly what they would have done. So it looked like they were being political.
That's a great point too about them changing policy because you didn't get a corresponding change in the data, right? It was not as if the labor market suddenly really deteriorated. It was not as if inflation suddenly cooled. You did not have. Right, Powell keeps talking about how they're data dependent, they're watching the data, they're data dependent, they're politically independent. Hogwash. It was very clear, I think, to markets exactly what you just said. There was a change in policy, and there was not a change in the underlying data that supposedly is behind those policy decisions. So I think you make a great point. There was a change in policy there.
I think the data change that they were looking at, which was incorrect, was the so-called SOM rule in August of 24. That is if the unemployment rate rises over 0.5% versus its low of the previous year on a 3-month average. That was triggered in August. There's a thing called the QCEW, the Quarterly Census of Employment and Wages, revision to the payroll report. That knocked it down 800,000 jobs. That's what I think panicked the Fed in the September move. But then it turned out after all of that those were not valid signals that the labor market was having problems, because it did not follow through that the labor market was having problems.
And so the only thing I'll say on the QCEW data, the Fed actually, several of the regional Fed banks use the QCEW data to produce their own what they call preliminary benchmark. So you were referencing, just for the audience's sake, the number you were referencing there, that huge downward revision. That's the annual benchmark that BLS does, where they take the monthly survey data and they adjust it given quarterly census data, which is much more accurate because it's a census, not just a survey of 2% of all the nation's businesses. And because the Fed has their own version of that they actually get to the Board of Governors ahead of the BLS's own annual release. That's why Powell said, we weren't surprised by that. We kind of saw it coming. We estimate that the
We lost you, EJ, for a bit.
Hopefully it comes back.
So this is a great moment to get the. EJ, we lost you. We have also a question from Kitty from the audience. Maybe it's a good moment. Kitty, go ahead.
Yes, thank you for the opportunity. Good morning, and Jim, I obviously watch your videos when they come out. A couple of questions that relate to the question you had yourself about why long-term rates are not going down. I mean, what's the wisdom or lack thereof of cutting rates into what is still inflation? Granted, we have disinflation, but we still have inflation, and we're still way above the 2% target. So cutting into that, I mean, isn't that what I would call almost irresponsible? But second of all, that's precisely because of that bond rates are, 10 years and beyond are not going down. And actually, if they did not cut, they would go down more easily because the bond market is kind of acting as its bond vigilante, as a bond vigilante essentially.
Yeah, so if I could jump in, there's an old adage on Wall Street that I can stop panicking when the central bank starts to panic. And there's a lot of truth to that because if you go back to 2022, the inflation rate hit 9% in 2022. What was the highest 10-year yield in that entire calendar year? Was in October of that year. It's 4.22%. Where are we right now? Well, according to my screen right now, we're at 4.18%. We're only 4 basis points lower than we were when we had 9% inflation. And we don't. We have 2.6 on core and 2.7 on headline inflation. So why are yields at effectively the same point that they were when we had 9% inflation? Because in 2022, the central bank was panicking. And therefore, I could relax about the outlook for inflation, and we don't have to drive interest rates to the moon. In 2025 and in 2026, the central bank is cutting rates and cutting rates aggressively, 175 basis points in September of 24. If they're not panicking, panic might be a strong word. Maybe I should be concerned that they're not panicking about the inflation rate. As you pointed out, we could say that inflation's under control. We could say that, everything is fine, and maybe it is. But the fact of the matter is it's almost been 5.5 years since we've seen a sub 2% rate on year-over-year inflation. It's been 5.5 years. And the bond market is of the opinion, I am not going to assume we're going to get back to 2%. I've made these assumptions in the past, and they've turned out in the past 5.5 years, and it's turned out to be errant. I will wait until we see it. And so therefore, all these rate cuts, like I said, might be counterproductive in that they are concerning the bond market, that the Fed is not serious about their inflation mandate.
I totally agree. Very quickly, Jim, on top of that, and which might be also a reason for the long-term rates to be pretty sticky around those levels. I mean, at what point do you get really concerned about the Japanese bond markets? I mean, rates were up another 12 basis points at the long end in Japan, and I have to believe that something is going to break. At what point are you getting really concerned?
Now, it's basically now that when you said something to break, there's another old adage on Wall Street that interest rates rise until something breaks. Because what happens is when interest rates start to trend higher and costs get to be more expensive, Usually they keep going and going until it becomes so punishingly high interest rates that they break something like the housing market or companies can't borrow or the financial markets, the stock market, buckles under the weight of high interest rates or something like that. And you're right. Interest rates in Japan have been absolutely soaring. They were up again. We're well over 2%. One of the other concerns that you would have about the Japanese rate, I'll use it from a U.S. perspective, is that the largest foreign owner of U.S. Treasury securities is Japan. It is not China. They're actually number 3 now, China. The UK is number 2, but that's usually because it's a lot of American investment banks and brokerage firms that have their London operations that accounts for the UK being number 2. But Japan is number 1. Now, why is Japan own well over $1 trillion of U.S. securities? Because for decades, their interest rates were 0, and they were looking for a yield, and they were looking for a safe yield. And they found that in the United States because we were much higher yield than them, and we were safe. Well, fast forward to today. We're at 4%, 4.18. They're at 2.12. All of a sudden, there's a yield again in Japan. And the gap between the U.S. and Japanese rates is narrowing. And that $1 trillion of Japanese money is starting to think, maybe I should be selling my U.S. treasuries and going back to Japan because I could get that yield back in Japan. And there's a concern that we might be seeing the exodus of one of our largest foreign holders. And I want to be careful in those words. Might be seeing. They haven't done it yet. But if these rates continue up, they will. And then the other thing is, bear in mind too, Japan counts taxes in their inflation measures. We don't. So if you exclude that, Japan also has an inflation problem because their inflation rate is 3%. Ours is 2.7. This is the first time in over 50 years, or almost 50 years, since 1977, that Japan has a higher inflation rate than the United States when you strip out that they include taxes in it and we don't, just so you have an apples to apples comparison. So they've got an inflation problem there that we have not seen in nearly half a century. And that's what you're seeing, I think, in their yields. But yeah, it is a concern that they keep going up and their economy, their financial markets will come under stress of higher borrowing costs. And from the U.S. perspective, they're the largest foreign owner. And if they start saying, hey, you know what, I don't need to own treasuries anymore. I could get a close enough yield. And if they keep going higher, an even close enough yield in Japan, I'll sell my U.S. treasuries and I'll go back to Japan.
Thanks so much.
Thank you, Jim. Thank you so much.
Thank you.
And thanks for awesome questions, because Japan is also on the top of my mind when we were doing Truflation analysis. Okay. I think
I'm gonna have to leave in about 5.
Yeah.
I don't know how we're doing
Thank you so much. We're already over just because the discussion was so absolutely amazing. And thank you so much for coming. I think EJ already dropped off. And we had one more person.
If you have one more question, I can answer it real quick, and then I got to run.
Not sure if they came on yet. The goat person? Nope. Okay, I don't think so. So thank you so much, Jim, and it was lovely to have you. And Oliver, thank you for your summary. And Stefan didn't get to speak. I'm sorry. Stefan, do you want to wrap something up? Stefan is our CEO of Truflation.
No, all good. Glad we had a hot debate and it was great. See you all next month. Look forward to that.
Oh, thank you, guys.
Thank you, Jim.
Talk to you later. Bye-bye.
Thanks. Bye.
Thank you.